Hello everyone, welcome to another video from DCF Model series by Valuation Interview Prep. In this we will be discussing about sensitivity analysis in this model. So let's directly jump onto that. In previously we calculated enterprise value using the two methods. One was perpetuity growth and another EBITDA exit multiple. Now for sensitivity analysis, we have some of the key inputs because we have two methods. So it's better to create two tables for both the methods. One is for perpetuity growth, I have terminal growth rate and the WACC as the key input parameters. Based on this, I can see that, okay, if my WACC is varying from 13.7% currently to let's say 0.5% less or more, and if my terminal growth rate is varying by 0.5% or more, then how overall the valuation of my firm will be varying based on this. This table is sensitivity table created a two variable table created by what if analysis. If you don't know this, you can simply select this as a whole. This terminal is linked to the value from where basically the EV is calculated, 4204. Here we need to hard punch the WACC number and this terminal growth number. You can also link these numbers, but many a times this table doesn't work if we are linking this. Post this, we go to data tab and perform a what if analysis. Here we have this data table. In the row input, my row is getting varied on the basis of this terminal growth. So I will just put here the link here terminal growth, and second in the column I have the WACC, and I will just press enter. Perform a control S. I guess I made some mistake in this. Let us try this again. What if analysis, we have the data table in the row input. Okay, in the row input we should be having WACC. Let's give the WACC input from here, and in the column input let's give the terminal growth rate. Yeah, it's fine now. Okay, so this is now correct. Basically we inputted the key in basically we had the wrong input of the parameters that we are using in this data table. So in row we have O20 is WACC, and in column variable we have this terminal growth. Okay, so next similar table we need to have for exit EBITDA multiple method also. Here also in the top we have all the WACCs, and here we have the multiples, and based on this we have a main value as 6,000 billion, and here we have 4,000 billion. Again, if you see how much is the total spectrum of the variation, if your highest value is coming from this 5622, if your WACC is minimum and your terminal growth is maximum, which is again true. If your WACC is getting reduced, then your valuation will be increasing, and same as for terminal growth is increasing, so also your valuation will be increasing. And your minimum value from this is coming to be as 3300 million. Sorry, this 3300 billion. Now in EBITDA exit multiple also you have the maximum valuation of somewhere close to 6900 billion and minimum of 5600 billion. Now as a consensus, we usually took the average of the two methods, which is terminal growth and exit EBITDA multiple, and here we simply have average of the above two tables. From this we come up to a valuation for this exercise, which is close to 5200 or 5000 INR billion. Now this valuation, if compared to the current valuation at which Infosys is trading, I guess Infosys is trading somewhere more than 7000 billion INR presently. So that's why this DCF model in itself is not a very it might be looking very simple, but ultimately the core part that is driving this model is the assumptions. If you uh, temper some of the assumptions, if you take a very much higher growth, if you perform it on a less WACC, if you say that WACC is too high right now for this, if you say that beta is too low, or if you adjust beta, based on that you can come up to the valuation which is current valuation. And even one thing to analyze in this is, even I have taken a very stable growth rate for a very big company like Infosys. So you can see that based on this also we are getting a valuation of 5,000 plus, and current valuation is 7,000 plus. So ultimately it also helps you to understand that how much growth is already captured into the Infosys company shares, Infosys company's share price. So you have to, if you reverse engineering it, you might be able to understand that okay, current valuation is too high or too or justified, because if you input some of the growth numbers which come to the current valuation of 7,000, and you see that okay, that amount of growth is definitely not reasonable, then you can get an idea that okay, currently market is overvaluing this company basis some EBITDA margin expansion or unreasonable growth or something, and based on that you can perform your analysis. So this is all for this part for sensitivity analysis, and next we'll be discussing the remaining sections of WACC and beta, and we'll be completing the model post that. Thank you.